It's Dave, and I'm going to say something that sounds impossible on purpose. We're starting with $1,200 and aiming at $1 million in a short timeline, with nothing hidden and no shortcuts. If your brain instantly said, "No way," good. That reaction is the barrier. Most people never build a plan because they confuse unlikely with impossible. Then they quit before math even starts. Here's the twist that keeps this honest. The 5-year version is aggressive, not magical, aggressive. It demands big deposits, calm nerves, and a willingness to be boring while other people chase thrills. We will build the 5-year turbo blueprint with real numbers. And then I'll show cleaner options for 7, 10, and 15 years, so you can pick the route you can actually sustain. And before you think this is about finding one perfect stock, I'll save you time. The engine is deposits plus reinvested dividends plus staying invested through ugly months when confidence disappears. Stay to the end, because I'll show the month where the snowball finally feels real. And I'll show what a $1 million dividend portfolio can generate as a steady cash run rate. Quick favor, after that big promise, tap like, subscribe, turn on notifications, and share this with a friend who needs a simple money plan with real math so you both follow the next blueprint together. And comment this, so I know your starting lever. Would you raise income, cut spending, or invest smarter first? And what would you do this week to make that choice real? Now we set the rules of the game, because the internet loves fantasies. We are not counting lottery wins, leverage tricks, secret signals, or day trading. This is the ownership route. We're using a simple long-term setup, broad diversification, dividend growth focus, and reinvesting every dividend from day one, even if the first payment looks like pocket change. No hero moves, just repeatable habits. We also assume you keep learning. You improve your earning power, you negotiate, you build a side engine, and you direct the extra cash into ownership instead of upgrading your lifestyle. Returns are never guaranteed, so I'll show a range. I'll model about 12% average annual total return for the main path, and I'll compare it to a tougher 10% world. Important detail: those return assumptions already include dividends being reinvested. We are not double counting. Dividends are part of total return, and reinvestment is what keeps them compounding. Keep it simple and track totals. Here's the truth you have to accept early. $1,200 is the match, not the bonfire. The bonfire is consistent deposits, because deposits control how many shares you own early. That is why time matters most. So think of this like a 5-year sprint with a backpack. You can sprint, but the backpack has weight, and the weight is your monthly contribution, not your motivation. This is the contribution ramp we'll use because it matches real-life growth. Year 1, $6,000 a month. Year 2, $11,000. Year 3, $13,000. Year 4, $16,000. Year 5, $19,000. Yes, those numbers are intense. That is the point. 5 years is not gentle. It is you buying time with effort, while compounding amplifies that effort in the background. You are trading comfort for speed. If you already feel resistance, do not leave. Later, I'll show the 7, 10, and 15-year routes with much lower monthly pressure, and they still end at the same milestone. Now we start year 1, and the mindset matters more than the ticker. Your job is not to predict the next headline. Your job is to keep buying ownership and reinvesting income. Month 1 starts with $1,200. That might be one diversified fund share or a small basket. It is not exciting, and that is why most people underestimate the power of starting. Your first dividend will be tiny, maybe a few dollars, and that tiny payment is not about the amount. It is about proof that capital can create cash without extra hours. That proof changes behavior. It turns saving into investing, and investing into identity. You stop asking, will this work? And you start asking, how can I scale it responsibly? That belief matters more than cash. So year 1 is boring on purpose. Deposit $6,000 by diversified dividend growers and reinvest every dividend automatically. No waiting for the perfect dip, no pausing for news. You are building the habit loop. By the end of year 1, under the 12% model, you're around $77,000. Under a 10% model, you're still about $76,700. Early on, deposits dominate the outcome. Early years feel slow, that's normal. That closeness teaches a key lesson. At the beginning, the market matters less than your consistency. If you can keep depositing, you can keep building, even if prices wobble. You win by controlling your inputs. Now let's translate that first checkpoint into dividend income. At a 2.5% average yield, a $77,000 balance produces about $1,925 per year, roughly $160 per month, paid quietly. And those payments can grow yearly. It will not change your life yet, but it changes your confidence. And confidence is fuel because it makes the next deposit feel purposeful instead of painful. Confidence keeps you depositing when bored. Year 1 also tests your attention span. Your friends will chase the hot thing. You will keep buying the boring thing. That discipline is the first superpower in this blueprint. Year 2 begins, and the deposit jumps to $11,000 a month. This is where the plan stops being a hobby and becomes a system. The numbers start demanding real trade-offs. Most people cannot do $11,000 without upgrading their income. So the blueprint assumes career moves, extra projects, tighter budgeting, and ruthless focus on deposits instead of lifestyle flexing. This is where plans often break. Here's why it matters. Bigger deposits early buy more shares early, and early shares compound longer. In a short timeline, time is scarce, so you must compensate with deposits. End of year 2, the 12% model lands around $226,800. The 10% model is about $223,000. That is roughly $250,000 built mostly by your behavior. At that size, a 2.5% dividend yield implies about $5,675 per year, around $473 per month, or about $1,420 per quarter. It starts covering real bills. It becomes visible progress, not theory. This is the temptation zone. You will want to spend that cash or celebrate with upgrades. If the goal is $1 million, you keep reinvesting because reinvestment is the accelerator pedal. Year 2 is also where volatility becomes your ally. If the market dips, your $11,000 buys more shares, and those extra shares raise future dividends when the cycle turns upward. So you stop fearing red days. You treat them like discounted ownership. Not because pain is fun, but because buyers with cash win when sellers panic. That mindset is the real edge. Now about dividend superchargers. A supercharger is not a meme stock. It is a business that raises dividends over time with strong cash flow and a payout ratio that stays healthy. In practice, many investors use a core diversified fund for stability. Then add a smaller layer of high-quality dividend growers they truly understand. The goal is durability, not drama. Now we enter year 3, and deposits rise to $13,000 a month. This is where the compounding engine starts sounding louder, because the base is finally big enough to amplify results. End of year 3, the 12% model is about $420,400. The 10% model is about $409,700. The gap is still manageable, but you can feel it widening slowly. At $420,000, a 2.5% yield is about $10,510 per year, around $876 per month, or about $2,628 per quarter. That is a second paycheck vibe for many people. Now the numbers start whispering freedom. Here is the month where it feels real for most builders. Around months 30 to 36, when dividends approach $500 to $900 a month and keep arriving without your permission. That is the psychological shift. You stop seeing investing as something you do. You start seeing it as something your money does, even while you sleep or travel or have a hard week. Year 3 also teaches a deeper point. Dividend growth matters more than starting yield. A growing dividend turns a stream into a river, while a shaky high yield can collapse. So we are not chasing the highest yield. We are chasing reliable payers that can keep paying, keep growing, and survive bad cycles without cutting the very cash flow we reinvest. This is where tracking matters. Once a month, you log deposits, dividends, and share counts. Not to obsess, but to see momentum, because momentum keeps you consistent. A notebook works, or a spreadsheet. If you want a simple target, aim first for $100 per month in dividends, then $500, then $1,000. Those milestones change spending habits because they prove your portfolio is alive. And remember, the plan is not linear. Some months will feel flat, some months will feel explosive. Your job is to keep the inputs steady, because the outputs arrive on a delay. Year 4 is where the story changes for real. Deposits become $16,000 a month, and the base is large enough that normal market moves swing your account by real paycheck-sized amounts. End of year 4, the 12% model reaches about $676,600. At 10%, it is around $653,600. Either way, you are deep in the $500,000 zone. This is no longer small money. This is the tipping zone. Once you cross $500,000, compounding starts looking unfair. A routine 1% week can be a new car in account value without any extra work. But the emotions also get loud. A 2% down day can feel like losing months of progress. So you need rules, because feelings are expensive and they cause bad trades. Dividend run rate at $676,600 with a 2.5% yield is about $16,915 per year, roughly $1,410 per month, or about $4,229 per quarter. That is serious cash flow. It can fund goals without selling. Now imagine reinvesting $4,229 every quarter, plus your monthly deposits into quality assets. That is a machine feeding itself, and the feed rate accelerates as the base grows. This is compounding with oxygen fuel. This is also where dips become gifts. When prices drop, reinvested dividends buy more shares automatically, and your deposits buy more shares manually. You are literally building faster in chaos. Most people do the opposite. They stop buying when fear is high, and they buy when confidence is high. This blueprint flips that behavior because compounding rewards the buyer, not the spectator. Portfolio construction matters here. You want a core that is diversified, a layer of dividend growers, and a small defensive layer, so you are less likely to panic in ugly markets. If you build something too fragile, you will sell at the worst time. Durability is a retention tool for your strategy, because the only unbeatable compounding is compounding you do not interrupt. Now, year 5 arrives, and this is the aggressive finale. Deposits hit $19,000 per month, and that is why I keep calling this the turbo path. It is intense by design. If you cannot sustain $19,000, you do not fail. You simply choose a different timeline, and I will break those timelines down right after we finish the 5-year math. Under the 12% model with our ramp, the end of year 5 lands around $1,003,000. That is the $1 million milestone, reached mostly through deposits and disciplined reinvestment. It is hard, but it works. Under a tougher 10% world, you land around $960,800. Still massive, and it proves the truth. Your behavior beats perfect returns because you can control deposits and reinvestment. That control is your unfair advantage. So how do you close a lower return gap? You add a few heavy months, use bonuses, tax refunds, side income spikes, or you extend the timeline slightly. Tiny tweaks become huge late. Even adding $2,000 more per month during year 5 alone moves the needle. Because contributions hit when the base is large and compounding is already running at full speed. Late contributions hit like a hammer. Now let's talk about the $1 million portfolio itself, because this is the payoff you stayed for. At $1 million, a 2.5% yield is about $25,000 per year. This is the cash flow snapshot. That is roughly $2,083 per month, or about $6,250 per quarter, arriving without selling shares. You can reinvest it, spend a part of it, or use it to reduce work hours. If your yield is closer to 3%, that becomes about $30,000 per year, or $2,500 per month. But higher yield can mean higher risk, so quality remains the guardrail. Also remember dividend growth. If dividends rise over time, the cash flow can climb even if you stop depositing. That is why people love dividend growth. It keeps paying while you keep living. Now, let's be honest again. 5 years is a performance plan. It demands income growth, and it demands you do not inflate lifestyle as income rises. The enemy is lifestyle creep. So here is the big takeaway. Compounding did not save you in 5 years. Deposits built the base, and compounding amplified the base into a milestone. The myth is reversed. If you want the cleanest summary, this plan is simple. Raise deposits, reinvest dividends, diversify, and never quit in the ugly months. That is the entire million-dollar formula. No tricks, just repeatable weekly actions. Now, I promised the alternative timelines, and this is where most people should breathe. Same destination, different pressure, different required monthly deposit, and different emotional risk. You deserve a plan that breathes. If we assume a constant monthly deposit and a reasonable long-term return range, the 7-year path can reach $1 million, with roughly $7,600 to $8,250 per month, depending on returns. The 10-year path is closer to $4,300 to $4,900 per month. That is still serious money, but it is within reach for far more people who build deposits gradually and stay consistent. The 15-year path can be around $2,000 to $2,400 per month. That is a completely different lifestyle pressure, and it is why longer timelines are secretly powerful for most households. Now you see the rule. Shorter time means bigger deposits and higher stress. Longer time means smaller deposits and more room to live while you build. Time is a discount on pressure. So how do you pick your timeline? Start with what you can sustain on your worst month, not your best month. Consistency beats intensity that burns out and leaves you broke and bitter. If you can deposit $2,500 a month, the 15-year path is not slow. It is disciplined, and it lets compounding do its job without forcing you into constant hustle mode. If you can sustain $5,000 a month, the 10-year path becomes a realistic mission. You can still travel, still help family, and still build ownership without feeling trapped. It fits many disciplined households better. If you can sustain $8,000 a month, the 7-year path is a strong balance. It is fast enough to stay exciting and slow enough to be survivable when life gets messy. And if you can ramp like the 5-year plan, that is the turbo lane. But you only stay there if it does not wreck your health, your relationships, or your peace of mind. Here is the line to remember. The timeline you choose is basically the size of the deposit you can keep showing up with. Even when motivation disappears for a month, now let's turn this into your personal blueprint. Step 1 is automation. If deposits rely on daily willpower, the plan dies. Automation makes progress happen while you are busy living. Step 2 is reinvestment. Dividends must buy more ownership until you hit your target. Taking cash too early feels good, but it delays the milestone and weakens the compounding engine. Step 3 is diversification with a dividend growth bias. You want a portfolio that can survive bad years without forcing you to sell, because selling breaks compounding at the worst moment. Step 4 is the anti-panic rule. You decide in advance that you do not sell because of headlines. You only change the plan if the fundamentals truly change for your holdings. Step 5 is income expansion. You do not need a miracle stock. You need a better skill, a higher earning lane, or a side engine that feeds deposits without stealing your whole life. Step 6 is a simple review rhythm. Monthly deposits, quarterly checkups, yearly rebalancing if needed. Keep it simple, because complexity is a sneaky way to avoid consistency. Boring is powerful because it repeats. If you want a practical checkpoint, aim first for $100 per month in dividends, then $500, then $1,000. Those milestones change how you think because income feels different than growth. This is educational content, not personal financial advice. Use this as a blueprint, then adjust for taxes, risk tolerance, and your real-life responsibilities, because real life always wins. Talk to a pro if needed. Now, I want to hear from you. Comment the timeline you are choosing, 5, 7, 10, or 15, and the monthly deposit you believe you can sustain for 12 straight months.